Thank you very much for joining the investor call held by Hang Seng Investment Management. My name is Terence, Head of ETF Sales and the host of today. Today we have our Head of Equities, Victor, and our Head of Product Specialist, Yvonne, to share their valuable investment insight with us.
If we look into the Chinese equity market, so what's the extent for companies being directly impacted from tariffs? So this slide here shows the revenue exposure for the major indices listed in Hong Kong. So you can see that the breakdown in terms of revenue derived from mainland China, Hong Kong, and Macau, and that's shown in the dark green bars. So for Hang Seng Index, it's accounting for 84%. For Hang Seng China Enterprise Index, as well as the Hang Seng Tech Index, they're accounting for 90%. And for the High Dividend 30 Index, it's accounting for 87%. So all these can give investors some reassurance and comfort that at the company level, Chinese companies are less reliant on the US.
I think China's economic background is still solid despite the trade war. And just as other markets, Chinese stock market in 2025, this year, has been quite volatile, mainly escalated by the US trade tariff since early April. So under this market environment, we suggest using a more balanced approach to invest in China. We recommend barbell strategy. The barbell strategy is especially relevant in periods of macro uncertainty, as it allows us to capture upside from policy-driven growth while maintaining defensiveness of the portfolio. And as you can see here, we recommend to hold a portfolio combining some defensive high dividend stock on one side and quality high growth name on the other side. High dividend names, say for example, include some Chinese bank, telecom, and also some utility companies, which have a relative mature business model and a relatively stable operation and generating a stable cash flow, which enable them to pay a dividend consistently. But at the same time, we will invest in some high quality growth stock, which can benefit from China policy support and domestic demand recovery, as highlighted by Yvonne earlier. For growth stocks, examples, information technology, those tech names, internet companies, and some selected consumer stocks. Given the impact on tariff, we believe domestic consumption stock can offer better protection against volatility from trade war compared to those export names.
Thank you very much for the time for joining our investor calls. So if you have any further questions regarding our investment view and strategies, please feel free to reach out your Hang Seng investment professional for further inquiries. And we would look forward to seeing you in the next event. Thank you.